Banks once felt like vaults guarded by marble columns, iron doors, and men whispering trust with polished certainty. People believed deposits were safe, accessible, withdrawable, promises backed by law and reinforced by habit everywhere. That belief built nations, markets, mortgages, pensions, and the quiet confidence required for ordinary families to plan tomorrow. But today, beneath the smooth glow of digital banking apps, a seismic shift grows silently without fanfare. A shift that threatens the very idea of deposits, ownership, access, and financial autonomy people assume immutable forever. For centuries, banking relied on a simple illusion: your money is waiting politely whenever you need it. But no bank holds enough cash to honor that promise if everyone demands it simultaneously without warning. Fractional reserves replaced vaults, liquidity replaced metal, and reputation replaced the actual ability to return deposits. Modern finance became a theater where stability depended entirely on confidence, not collateral, discipline, or mathematical certainty. The illusion worked brilliantly until the day confidence cracked, revealing deposits as vulnerable, not guaranteed, instruments completely. History whispers this truth through collapses people prefer forgetting, because forgetting feels safer than uncomfortable recognition today. In 1933, American banks shuttered overnight, leaving citizens pounding locked doors during the Great Depression panic. Deposits froze, currencies trembled, and Roosevelt declared a bank holiday because the entire system nearly dissolved entirely. Trust evaporated faster than lawmakers could speak, revealing how fragile deposit-based banking becomes when fear moves faster. When people demanded money simultaneously, money ceased being accessible, revealing banking as faith, not physics, completely. Centuries earlier, European deposit banks collapsed under wars, monarch defaults, and panics ignited by sudden rumor storms. The pattern never changed. Deposits freeze, withdrawals halt, governments intervene, and savers learn their money vanished quietly. Each collapse rewrote laws, then repeated the cycle, proving reforms treat symptoms, while incentives quietly revive instability. Even in modern times, with glossy apps and FDIC logos, deposits remain vulnerable to coordinated panic responses. 2023 reminded America when regional banks collapsed within days after digital whispers triggered stampedes nationwide. What once required long lines and newspaper headlines now requires a tweet, a rumor, or encrypted group message. Money moves faster than regulators, faster than deposit insurance, faster than banking laws designed for slower eras. When deposits vanish digitally, banks collapse physically, revealing a mismatch between 20th century rules and 21st century realities. This mismatch sets the stage for something unprecedented: the replacement of traditional deposits with programmable digital instruments. Not because governments prefer innovation, but because current systems cannot survive speed, scale, and panic combined. Central banks noticed the cracks long before citizens did, studying how withdrawals destabilize economies during fragile seasons. The idea of a central bank digital currency CBDC emerged as a solution disguised elegantly as modernization. Digital money issued directly by central banks requires no deposits, no private intermediaries, no liquidity juggling. It promises instant settlement, programmable controls, fraud reduction, tax transparency, and resilience during crises demanding rapid responses. But beneath this technological glow hides a reality darker than any depositor collapse recorded across financial history. When central bank money replaces deposits, traditional banking loses its core function, holding public funds safely. Banks transform from custodians of national savings into mere lenders dependent on wholesale markets for funding. Deposits disappear, replaced by government-controlled balances updated by algorithms and accessed through state-managed financial gateways. For citizens, this shift feels convenient instant payments, listvers, no overdraft, and garantieware. But convenience becomes camouflage when financial autonomy fades quietly beneath features marketed as progress. Modernization and safety. Under a CBDC regime, governments can monitor, freeze, redirect, or restrict money with unmatched precision and immediacy. Sanctions become lines of code. Taxes become automatic debits. Welfare becomes programmable allowances enforced algorithmically. Fear-driven withdrawals become impossible because digital balances never leave central bank balance sheets under any condition. Bank runs disappear, not because systems gain strength, but because the public loses control over liquidity completely. Deposits once represented personal autonomy. CBDCs represent controlled participation, conditional, monitored, revocable, and fully programmable. History shows governments rarely resist expanding power when crises offer credible justification to intervene aggressively. In wartime, currencies are controlled. In depressions, withdrawals freeze. In emergencies, autonomy shrinks under patriotic language. CBDCs simply make these controls permanent, instantaneous, invisible, and embedded within everyday financial routines unknowingly. China already demonstrates programmable digital currency with expiration dates, geographic spending limits, and purchase restrictions implemented. Such tools allow governments to guide behavior not through incentives, but through direct control over individual transactions. Western nations watch closely, adopting slower, subtler versions pilot programs, regulatory frameworks, and modernization initiatives implemented gradually. What begins as faster payments becomes digital identity, then integrated tax compliance, then programmable monetary functions, step by step. Deposits migrate from banks to central authorities, replacing private balance sheets with public ones. Citizens barely notice the transition because interfaces remain familiar apps. Cards, taps, but infrastructure transforms beneath screens silently. By the time change becomes visible, traditional deposits exist only in museums, textbooks, and nostalgic financial documentaries. Banks cannot survive this transition through tradition. Because their core product deposits becomes technologically obsolete beyond repair, some pivot toward wealth management, others toward lending platforms. Others vanish into consolidation, waves triggered by necessity. The branch network shrinks, credit creation shifts, and bank influence wanes as central banks dominate infrastructure completely. This shift mirrors past revolutions: gold replaced by paper, paper replaced by electronic ledgers, ledgers replaced by algorithms. Each transformation rewarded those who anticipated change early and punished those clinging to fading financial architectures. The Disappearance of deposits alters credit entirely, forcing banks to borrow wholesale rather than attract community savings. Credit pricing rises, lending tightens, risk increases. And small businesses struggle against institutional giants, effortlessly advantaged. Local banks become relics. Global institutions dominate. Financial ecosystems centralize as decision-making migrates upward systematically. Economies dependent on broad credit access weaken, while digital authoritarian models gain leverage through programmatic money control. The consequences extend beyond banking. They reshape society, power, opportunity, and the line separating autonomy from obedience. Money once served citizens. In a programmable world, citizens serve the architecture, governing money itself daily. The most dangerous part is that people accept this shift willingly because collapse scares them profoundly. When deposits become unreliable, the public begs for stability regardless of the cost extracted silently later. Governments offer digital certainty in place of analog chaos, and citizens trade autonomy for safety unthinkingly. History shows populations accept control when fear eclipses freedom, and crises create perfect conditions for transformation. This is the endgame of deposit-based banking, not destruction, but replacement by something far more controlled. Not a bank run, but a migration. Not failure, but evolution. Not chaos, but enforced stability algorithmically. The system doesn't collapse explosively, it dissolves quietly, replaced by infrastructure that appears safer but feels different. Power shifts from many banks to one central authority capable of shaping behavior using programmable currency. The world keeps functioning, but the meaning of money changes entirely, altering how citizens participate economically. Deposits disappear when trust disappears, and trust disappears when institutions overpromise, underdeliver, and collapse repeatedly. The public eventually demands a system incapable of failing, even if that system cannot tolerate independence. Digital money satisfies this demand by eliminating failure while introducing unprecedented oversight and programmability globally. Thus, the future of banking is not bankruptcy or crisis, but transformation into a new financial architecture. An architecture where deposits vanish, central banks dominate, and money becomes a tool of policy distribution. Yet a deeper question lingers beneath this transformation, unasked but critically important for understanding tomorrow's economy clearly. If central banks control money directly, who controls the central banks shaping every citizen's financial destiny silently? If deposits disappear, who safeguards the boundary between ownership and permission within digital financial ecosystems permanently? If programmable money governs behavior, what happens to dissent, privacy, autonomy, or resistance expressed economically today? These questions shape the next chapter of global finance because digital money answers them without asking permission. See, BDCs do not merely modernize finance. They rewrite the relationship between citizen and state fundamentally forever. They redefine ownership as access, privacy as privilege, and autonomy as conditional compliance enforced through algorithms. The end of banking is not about banks dying. It is about banking transforming into governance, and governance transforming into software, code, and programmable logic controlling the flow of national resources. This shift marks the most significant financial transition since the invention of money itself centuries ago. The stage is set, the architecture built, the crisis incentives aligned, and the technology fully prepared today. What remains is a catalyst, another panic, another collapse, another freeze that convinces the public to embrace CBDCs, not as an option, but as a necessity. Not as an upgrade, but as an unavoidable evolution. When that moment arrives, deposits vanish instantly, replaced by balances recorded in centralized government databases. And the age of digital money begins not with fanfare, but with the quiet extinguishing of financial independence. When deposits from banking wish if one feels you then, normal inish. People continue tapping cards, paying bills, transferring money, unaware the foundation beneath them has vanished completely. Bank accounts still display balances, yet those balances behave differently, permissioned, programmable, and controlled centrally. This is how financial revolutions happen, quietly, gradually, behind interfaces designed to hide structural upheaval effectively. By the time the public notices, banking has transformed into a government-directed liquidity system managing economic behavior directly. CBDCs sit at the heart of this transformation, marketed as safer, faster, cheaper, and more inclusive innovation. A central bank digital currency doesn't need deposits, branches, insurers, or traditional risk management built for fragmentation. Money becomes software running on a national server governed by algorithms enforcing real-time economic rules instantly. Every transaction becomes trackable, classifiable, and analyzable, turning personal finance into state-observable behavioral information. Autonomy shrinks as convenience grows, and citizens mistake loss of privacy for technological progress wrapped attractively. For banks, losing deposits rewires their purpose, shifting them from community institutions into regulated credit distribution engines. Without retail funding, banks borrow from wholesale markets, institutional partners, and central liquidity windows determining credit capacity. Large banks adapt quickly, leveraging scale, technology, and political influence to secure privileged access to digital capital. Small banks struggle, unable to compete for wholesale funding or maintain relevance without traditional customer deposits. Financial diversity erodes, leaving national credit policy shaped by a handful of approved megabanks aligned with government directives. Credit allocation becomes algorithmic, optimized for economic priorities chosen by policymakers rather than decentralized market judgment. Loans go where models predict national benefit manufacturing. Energy, strategic, technology while riskier sectors starve quietly. Entrepreneurs face automated eligibility filters. Decline reasons become mathematical rather than relational or negotiable with bankers. The human element in credit disappears, replaced by data-driven scoring systems reinforcing systemic inequality predictably. Innovation suffers when credit becomes bureaucratic, because algorithms rarely fund unproven ideas challenging established norms. Programmable money expands state influence dramatically, offering tools governments once only dreamed of possessing unobstructed. Stimulus can expire, purchases can be categorized, Spending can be redirected, and savings can be limited algorithmically. Taxation becomes automatic. Penalties apply instantly. Benefits distribute conditionally without administrative processes or appeals. Financial freedom, once defined by the ability to save, spend, and transact autonomously, shrinks into regulated pathways. CBDCs amplify these capabilities by enabling enforcement instantly, without banks, courts, or logistical obstacles delaying authority. What required legislation in past decades now requires nothing more than a software update applied quietly overnight. Internationally, programmable money becomes a geopolitical instrument reshaping alliances. Sanctions and global economic leverage fundamentally. Financial exclusion becomes precise. A nation, corporation, or individual can be cut off from digital money instantly. Sanctions shift from paperwork to code. Compliance becomes automatic. Enforcement becomes global and nearly frictionless. Currency blocks emerge: digital dollar regions, digital yuan nodes, digital eurospheres, each competing for strategic dominance. This competition redefines supply chains, trade agreements, diplomatic relations, and global financial stability significantly. For ordinary citizens, the disappearance of deposits alters daily life far more than officials initially disclose or acknowledge. The wealthy adapt easily, insulating themselves with offshore assets, international accounts, gold reserve holdings. They diversify outside the programmable system, maintaining autonomy unavailable to ordinary citizens limited to domestic rails. The middle class becomes fully dependent on digital infrastructure, unable to escape programmable constraints governing transactions. The poor face the strictest control: spending categories, consumption limits, and automated welfare oversight monitoring every purchase. Inequality shifts from financial to algorithmic, encoded into digital architecture that determines access to upward mobility. Corporations reshape business models to integrate programmable payments into pricing. Subscriptions and customer behavior incentives. Insurance adjusts premiums dynamically. Employers tie compensation to spending categories. Retailers price goods algorithmically per consumer. Data becomes currency because spending behavior reveals identity patterns more accurately than traditional demographic profiling. The economy reorganizes around behavioral predictions, and programmable money becomes the core data source powering corporate strategy. Consumers adapt unconsciously, training themselves to purchase in patterns rewarded by algorithms controlling digital advantages. Resistance emerges only when restrictions become visible limits on transfers, blocked donations, or expiration dates on savings balances. But by then, alternative systems cash, private banks, independent money no longer exist or remain heavily regulated. Black markets appear, using foreign cash, gold, crypto, or barter networks to restore autonomy when official systems tighten. These underground economies mirror past eras when governments overreached, and citizens sought alternative value mechanisms secretly. The cycle reflects a timeless truth. Centralized power inevitably expands, and individuals always seek escape routes for independence. Governments, however, maintain public support by framing programmable money as essential for protecting stability and preventing crises. A major bank failure could prompt calls for safer, government-backed digital accounts bypassing fragile private institutions. A recession could justify programmable stimulus to ensure rapid circulation rather than savings. Accumulation slowing recovery. A cyber attack on banking infrastructure could accelerate adoption of unified digital rails touted as secure replacements. Fear becomes the accelerant, transforming controversial tools into widely accepted safeguards appearing necessary for survival. As deposits disappear, financial literacy becomes more important than ever, though few citizens grasp underlying mechanics accurately. People misinterpret current banking, believing deposits sit idle in vaults rather than funding loans immediately. If they misunderstand today's system, they are unlikely to question programmable money replacing it entirely. Governments present CBDCs as modern, reliable, and inclusive simple narratives appealing to populations overwhelmed by complexity. Without deep understanding, convenience defeats skepticism, and people trade autonomy for ease without recognizing long-term consequences. The disappearance of deposits marks not collapse but restructuring, replacing decentralized risk with centralized precision control. Bank runs vanish because withdrawals no longer threaten liquidity. Programmable money cannot leave the digital perimeter. Interest rates become dynamic tools applied individually, incentivizing spending or saving based on macroeconomic needs. Monetary policy becomes surgical, targeting sectors, regions, or demographics, with tailored incentives or penalties automatically. This efficiency dazzles economists but raises profound concerns about governance, accountability, and individual rights. In this new world, true financial independence depends on assets outside programmable control gold. Land, crypto, businesses, skills. These hold value independent of algorithmic permission structures, preserving autonomy in systems designed for centralization. But access to such assets requires education, planning, and foresight many citizens lack or cannot afford realistically. Thus the economic divide becomes philosophical. Those who prepare gain freedom, those who don't become digitally dependent. The transition redefines wealth, not by money held, but by control retained in increasingly permissioned systems. The end of banking is ultimately misnamed. Banking doesn't, and it transforms into something unfamiliar but deeply powerful. Deposits disappear, but credit remains. Cash dies, but transactions flourish. Autonomy shrinks, but efficiency expands. The world moves from fragmented institutions to unified monetary architecture controlled by central authorities algorithmically. Whether this future empowers citizens or restrains them depends on how societies respond before programmability becomes irreversible. Because once the rails are built, the rules become permanent, and financial freedom becomes whatever the system allows. If this story gave you a new way to see history, technology, money, and power, subscribe.